morning, good afternoon, and good evening. Welcome to a new episode of Pair Trade Finder Pro, where in this occasion we are analyzing the companies Ecopetrol and Shell, both in the energy industry and both in the oil and gas subsector. The tickers for those are EC and Shell, and the signal was triggered by the software 4th of March, and the exit was 11th of April. We're gonna see that maybe it was even more convenient to exit before that. But let's go step by step. And what we are gonna do as always is analyze all parameters in this checklist and see how they appear at the end to take a final decision on whether to take the trade or not. In this occasion, I'm gonna go through all the parameters in sequential fashion, but instead of coloring the chart, I will do it at the end. First thing is the signal was on the 4th of March, and we see here that there was a deviation of 3.47 that seems to be a little bit high, but as you see here, the signal was built up in several days. So we can see here that that was not the consequence of an all of a sudden new. It was something that was built in a period of time.
In any case, it's very important to always check news in detail in order to avoid potential surprises once we are in the trade. So for Ecopetrol, earnings release was end of February, so there was still 4 or 5 more trading sessions for the price to stabilize before the signal was triggered. So I consider that time more than enough. And there's no other thing that I see around in Ecopetrol. So related to Shell, nothing relevant either, apart from the fact that maybe on the 4th of March, it says here that Shell bought a cargo of Russian crude, but that's something. It was already discounted in the price. So all the context of the Ukrainian war have already discounted this kind of situations, and I don't think this new can have a big impact on the price. Shell, in terms of earning dates, already happened on the 3rd of February, so that's not affecting either the situation.
And the dividend for EC was on 19th of April, and for Shell it was 19th of May. So in terms of dates, that is completely clear. Let me show you where you can find that information, because that is one of the things that the software can provide you very, very easily. You go to the fundamental correlation screen, ask for the information, and what you see here is the different financial parameters for both companies. At the end, you can see that there is the field of next earning dates, that in this occasion, the software has not been able to extract from FinBINT, because as you see here, these are two companies that are not based in the United States. So I'm going to tell you now how to fix that immediately. But for the time being, you just stay with the fact that the dividend dates was for IC on the 19th of April and 19th of May for Shell. So time more than enough if our signal was on the 4th of March. Rest of the parameters are more or less okay. Same sector, same industry. Beta slightly problematic here because EC is far more volatile than Shell. So maybe you want to take into consideration that and reduce easy leg. That's up to you. In terms of capitalization, both companies are pretty big, so no issues on that. And related to price sales, price book value, cash flow, they seem to be in range. In terms of fundamental correlation, apart from the beta detail, you want to go ahead. Let me just show you how you can fix if you find a ticker that is not being extracted by the software. You can go to this website, Earning Whispers, and in this site you can just type in the ticker of the company you want to look for. You get all the data. Let me go back just for a second to here to the EC and the fundamental snapshot. Because you may be argued that the dividend for Ecopetrol on the 19th of April is in front of our trade, and it's against us because we are going short on Ecopetrol, and that's true. And it's a substantial dividend, but from 4th of March to 19th of April, we think we have time more than enough. Next one is Pair Momentum. Pair Momentum is it's okay. You can see that the signal, the ratio signal, was going up and down with some trending periods, but the thing that convinced me to take the trade is the fact that trending was going down and the signal was above that. So that is, for me, a clear indication that the probability of reverting back is higher. So per momentum is okay. Ratio chart in terms of resistance, it's good also. Let me just show you where you can find this information here. You can see that in terms of standard deviation, there is clearly a signal that is in this resistance level, if not even a little bit above it. So again, that's probabilities to reverting very fast. And also, and even more exaggerated in the chart of percentage from mean, you see that the signal was even above the resistance level that you can draw here. So that is also a go for the ratio chart. RSI is quite interesting because when the signal was triggered, which was here, if I expand this graphic, you see that RSI was beginning to trend down. That is a divergence, and a divergence always means that the reversion to mean and the possibilities are very high. Correlation was 66%, which is a good number and growing. No issues with correlation. Good enough and growing. Co-integration was, let me go to backtest and show you that is 0.995 co-integration in a period of 2 years, which is quite good. Correlation is almost 70% as an average of these 2 years. Very good also. I mean, the combination of this high correlation and, co-integration and this high correlation is very good news for us. Volatility, let me go to volatility chart. Volatility was 1.78, which is below 2 or 2.5, which normally is our limits. So we are gonna go with 5,000 per leg, full 5,000 per leg, because the volatility for this pair is very much under control. Now let me go back to the backtest parameters, and what we observe here is that the CAGR, the compounded annual growth rate, is slightly more than 6%, and the drawdown is 12.37. We like to see the CAGR higher than the drawdown, but it's not the case. We have to keep in mind that the drawdown in this occasion is still below 20%, which would be our limit. But this is something that we will mark in red in our cheat sheet because the compounded annual growth rate is lower. Another detail that you want to take into consideration is that the average net profit per trade is 125. We like this number to be above 200. Normally with 5,000 legs, we want to see this number higher than 200. But keep in mind that the nice combination of co-integration plus correlation and 5 trades, which is in 2 years a very good number of trades in terms of building our statistics. I still would have go ahead even if this parameter here is slightly below what we expect. Let's go back again to the pair charts, and this is the execution of the trade, how it was developed in time. And what you observe is that it was initially at 3.47, and this is what I was telling at the very beginning. Even if it ended up below 1 11th of April, we should have exited the trade on the 15th of March. The reason is what we always call the 1.7 rule. It's when you have this standard deviation, you don't want to wait all the way to 1 standard deviation. If the difference between the initial standard deviation 3.7 and the number 1.7, you make that subtraction, and then you get 1.77. So at this point that I'm marking here, we should have exited the trade. Several reasons for that. Number one, if you do it this way, you're gonna be far quicker getting your money in your pocket. But it's not only that, it's also the fact that by being faster in exiting the trade, you are risking less your position. Just take always into consideration that the more you are in the trade, the higher the risk you are taking. All in all, let's go back to our presentation, and this is the appearance of the cheat sheet. We already mentioned that in CAGR and drawdown, we are gonna mark this in red, but everything is in green. So this is for me clearly is a go. And that's basically it. So let me wish you very good trading and see you in the next episode. Take care.